part of the reason why it was surprising that there wasn't a lot of research on this in the academic world prior to, the 1990s was that, at least from my perspective, this was the obvious thing to look at. Okay. Any of our theories of market inefficiency are going to have some sort of story where the market either overreacts to information or underreacts to information. If the market tends to underreact to information, you expect to see continuation. Stock price goes up, from 10 to 15, but it was an underreaction. So then later it goes up from 15 to 20. Or it could be an overreaction. It goes from 10 to 20 and then back to 15. So from our perspective, that was sort of the obvious type of test that you'd want to run if you want to think, as first principles on market efficiency. Does the market react appropriately to information?
Today's podcast is brought to you by the Freedom Day Dividend ETF. We know Ryan Kruger very well. Ryan and his team have been managing money for private clients through many market cycles since 1996. Their strategy is focused on finding companies with the potential to increase their dividends. Now, for the first time, they're offering an actively managed ETF for investors everywhere. The ticker symbol is MBOX, MBOX, as in mailbox, designed for shareholders searching for opportunities to receive more mailbox money.
The fund's investment objectives, risks, charges, and expenses must be considered carefully before investing. For this and other important information about the fund, please visit freedomdaydividend.com for a prospectus or summary prospectus. Read it carefully before investing.
Welcome to Excess Returns, where we focus on what works over the long term in the markets. Join us as we talk about the strategies and tactics that can help you become a better long-term investor.
Justin Carbonneau and Jack Forehand are principals at Validea Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Validea Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validea Capital.
Hi guys, this is Justin. In this episode of Excess Returns, Jack and I have the privilege of talking to Sheridan Titman, Professor of Finance at the University of Texas at Austin, where he holds the McAllister Centennial Chair in Financial Services at the McCombs School of Business. Those in the academic finance world, as well as practitioners using quantitative and momentum investing techniques, know Sheridan as his 1993 paper with Narasimhan Jegadeesh is considered the seminal research on momentum-based stock selection strategies. We talked to Sheridan about momentum investing, why it works, and how to best measure it. Our conversation then goes into other areas of his research, including value in glamour cities and the impact of geographic location on a firm's value, and much, much more. As always, thank you for listening. Please enjoy this discussion with Sheridan Titman. Hi, thank you so much for joining us today.
Hi, how are you doing?
We are excited to have you on. I was recently in touch with one of our previous guests on the podcast, Partha Mohanran, who's a professor at the University of Toronto. And I told him we were having you on, and he actually called you a legend.
Well, that's very generous.
I thought you'd get a kick out of that. But I think you've published over 250 research papers and articles. You've been cited over 60,000 times. So I think in many academic finance circles and probably a lot of quantitative firms that utilize momentum, you probably are a legend in a lot of people's minds. So let me read you a passage from the book Quantitative Momentum, which was written by our friends over at Alpha Architect. I think what I'm going to read provides some interesting context and color as to what was happening in the market at that time and how it was changing. And after I read this, I'd like you to comment on it, if you don't mind. So it says, momentum rises from the ashes. Finally, in the early 1990s, Jegadeesh and Titman revitalized the findings from Levy's 1967 paper in their pioneering 1993 article, Returns to Buying Winners and Selling Losers, Implications for Market Efficiency. The paper essentially replicated the spirit of the analysis conducted by Levy in 67, but with the benefit of more data, computational power, and willingness on behalf of the establishment to publish research that questioned the efficient market hypothesis. By now, the cracks in the efficient market hypothesis armor were getting bigger. Interestingly enough, Jegadeesh and Titman never mentioned the word momentum in their original paper, even though their paper is considered by many to be the seminal work on modern era stock selection momentum strategies.
Okay, in terms of what was going on in the academic world at that point in time, there were a lot more people questioning the idea of market efficiency. So it's clear that the profession was open to the ideas. It's still somewhat of a mystery to me that we went from 1967 when Levy, talked about these strategies where, again, he had a test that wasn't particularly powerful and what he found wasn't that strong. But we went, over 20 years, without people doing a serious job of, doing what Jegadeesh and I did, was very seriously look at momentum strategies.
Can you give us an overview of what you found and what your research uncovered in your paper, Returns to Buying Winners and Selling Losers, Implications for Market Efficiency?
Okay, let me just first say that part of the reason why it was surprising that there wasn't a lot of research on this in the academic world prior to, the 1990s was that, at least from my perspective, this was the obvious thing to look at. Okay, any of our theories of market inefficiency are going to have some sort of story where the market either overreacts to information or underreacts to information. If the market tends to underreact to information, you expect to see continuation. Stock price goes up, from 10 to 15, but it was an underreaction. So then later it goes up from 15 to 20. Or it could be an overreaction. It goes from 10 to 20 and then back to 15. So from our perspective, that was sort of the obvious type of test that you'd want to run if you want to think, as first principles on market efficiency. Does the market react appropriately to information? Okay, so what we do in that paper is we look at lots and lots of different intervals. We're looking at different holding periods, and different formation periods. So we would look back 3 months, rank returns based on the past 3 months, hold for the next 3 months, hold for the next 6 months, hold for the next 9 months, hold for the next year. Then we look at a look back period of 6 months. And again, looking at returns at 3 months, 6 months, 9 months, and a year, and so on and so forth. So we looked at, lots of different intervals and then did a careful statistical test that would control for the fact that we're doing some data mining and then ask the question, do we find more excess returns in all these strategies than we would expect from chance? And the answer is yes. We could very soundly reject the hypothesis that returns were basically following a random walk.
Just to follow up on the point with respect to holding periods and the periods to measure momentum. You mentioned you looked at a lot of periods in the paper, both with respect to the how you were measuring it and the holding periods. What did you find were sort of the best periods in terms of momentum?
The one that we focused on in the 93 paper was the 6 month strategy. Now, one thing that we also found, though, and Jegadeesh has looked at this in other contexts as well, was if you look at returns in a 1 month period, there was strong evidence of reversals. So what goes up in, this month is going to tend to go down a little bit the next month. So actually the best strategies were ones where we would have, say, a formation period of 6 months, and then we would skip a week and hold it for the next 6 months. So we did quite a bit better by skipping the week, which basically takes away that reversal effect.
When you look at the way practitioners use momentum right now, I think probably the most predominant measure, at least for the people we follow, is this idea of 12-1 momentum, which gets at what you're talking about with the short-term reversal, 12-month momentum minus excluding the most recent month. Do you think, based on your further research, do you think that's a pretty fair way to measure momentum?
Yeah, that's the way that, there's various ways of doing it. But that basic idea that you want to control for the 1 month reversal definitely makes sense.
Another thing I always find interesting when looking at academic research, because those of us who use it typically use the long side of it and not the short side of it, is, when we had as Justin mentioned, we had Partha Mohanram on the podcast, and in his paper, the vast majority of the return came from the short side versus the long side. And I'm wondering, when you looked at momentum, how that compares, sort of the returns on the long side of it versus the returns on the short side.
Okay, I tend to be very sympathetic with the idea that you expect to have greater returns on the short side. Okay, but that result that you get more on the short side isn't robust in the sense that it depends on how you adjust for risk. Okay, so it looks to me like, at least the historical evidence, there's certainly excess returns on the long side as well as the short side.
And you alluded to this earlier, but when people look at momentum and why it works, there's tend to be two camps. There tends to be the camp of the risk-based explanation, the efficient market type people, and then there tends to be the behavioral based explanation. I'm wondering, do you see value in both of those? You alluded to the behavioral explanation before. Do you see much more value in that, or do you see value in both explanations?
No, it's behavioral. I don't put much weight on the rational stories. I mean, you can always come up with a rational risk-based story, and maybe there's something to that, but this is mainly a behavioral issue. I have a very recent paper where we look at Chinese A and B shares. Are you familiar with that, the A and B markets in China?
Yes.
Okay, so they're exactly the same stock, basically. They both trade in China. Okay, but the A market is basically the domestic market where you use the local currency to buy the stock. And in the B market, you need access to US dollars or Hong Kong dollars to buy the stock. So the stocks don't exactly move in the same place. The dividends are identical. So it's the best experiment you can have in terms of basically saying, I want an experiment where the return differences have nothing to do with the fundamentals of the firm. It has to do with the moods and views of the actual investors. And so what's interesting is that in the A market, there's no momentum. That's kind of well known. People talk about the fact that in the Chinese market, you don't see momentum. And in the Chinese A market, you see pretty strong reversals. Now, the B market, exactly the same stocks in the sense of exactly the same dividends and exact same fundamentals. Okay, but those stocks do in fact show momentum, and you don't see reversals in those stocks. Okay, so it's the nature of the individuals that are generating these return differences.
I want to ask you, one of the things you alluded to in your 2011 paper is this idea that since the publication of your original paper, the excess returns from momentum maybe haven't been as strong as they were in the research. And you sort of alluded to that, and you talked about the influence of 2009 on that. And I just want to maybe ask you, what do you think about that? Do you think maybe momentum is not as strong now as it was in history, or do you think maybe something else is going on?
I'd be very surprised if it was as strong. I mean, again, I view this as an anomaly in the sense of the market's underreacting to certain types of information. And, in the 90s, you had Cliff Asness and a few of those guys trading on momentum, but very few institutional investors, a lot of them were buying winners and so on and so forth. But there weren't a lot of hedge funds that were very seriously trying to, arbitrage away this momentum effect. After 2000, just lots of these quant equity guys, and almost all the quant guys that I talked to had momentum one way or the other in their models. So it'd be very surprising if the influence of those investors didn't in fact have an effect on return patterns. So we do have, weaker momentum after 2000. A big part of the weaker momentum of after 2000 is kind of a really bad period for momentum, between 2007, 2009. But yeah, I would find it surprising if that strategy works as well going forward.
One of the things we like to highlight whenever we talk about factors on our podcast is not just the strengths, but the weaknesses. And I'm wondering if you had to talk about what the major weaknesses of momentum are, or are there certain things you would highlight?
I'm not sure how I'd say weaknesses of momentum. I mean, again, unless you want to say that, I would say the main weakness is this is a very simple strategy. Everybody is aware of it. So it's very unlikely that you can make money using a very simple momentum strategy going forward. Okay. That doesn't mean that momentum can't be part of a more sophisticated strategy, but, it's too simple on its own.
One of the other things you talked about in that paper was the idea that stock momentum is driven by industry momentum. And I'm just wondering if you could talk a little bit about what you found by that, about how much of the momentum in stocks is maybe explained by industry momentum.
Yeah, I don't think that's necessarily the case. I think the industry momentum, to a large extent, is different than the individual stock momentum. I think a big part of the industry momentum is caused by leads and lags. I think there's clearly a non-industry element to momentum.
That makes sense. And did you also talk about the momentum in the economic cycle in that paper? Do you find that momentum works better in certain parts of the economic cycle, or do you think it's sort of irrespective of the economic cycle?
Historically, the momentum has worked better following bull markets. And when the economy is going well.
The last one I want to ask with you on momentum before we sort of shift a little bit is this idea of fundamental momentum and price momentum. So the idea that, some people would say your momentum signal is basically captured, completely in price. Some may say you could effectively improve a momentum signal by looking at maybe firms that have improving EPS, for an example, or improving sales along with the price momentum. I'm wondering if you've done any work around that and if you have an opinion on that issue.
Yeah, I think there are two. I would say there's independent signals, but both signals are important. You would say that one signal subsumes the other signal. And I'm looking a little bit at that with Jegadeesh now. And it's, I don't think we have anything we want to report yet. But in terms of the timing of the momentum, I think it does matter where you are in the earnings cycle. So if you're buying, right before the earnings announcement versus right after the earnings announcement.
In looking at the time since you published that paper, what do you think are the major lessons that you've learned when it comes to momentum investing?
I mean, we've done lots of different studies after that. I would think the one thing that I initially found surprising was if you look at momentum around the world, the momentum strategy seems to work best in markets that you might think are the most efficient markets. Okay, so the momentum worked very well in the United States. It worked very well in the UK. Did not work well in Japan. Did not work well in China. Actually, as Japan has gotten, much more developed as a market, more efficient as a market, the evidence of momentum in Japan has actually increased rather than decreased. And if you look over the last 10 years, for example, momentum's weak in the United States and it's weak in Japan. And you can't really tell the difference between Japan and the US. So this isn't the type of thing where as the markets get more and more efficient, momentum seems to go away. It seems to be sort of the opposite.
Wow, that's very interesting. Do you have any theories as to why that might be?
Yeah, I do. I think the momentum is driven to some extent by investors that are, fairly rational, except for the fact they're a bit overconfident. And if you look at the institutional investors in the Western world, I think that's a reasonable characterization. And if you have, fairly smart investors that are overconfident, they're going to tend to think that they sort of know everything, and they're less concerned about what I'd call adverse selection. Less concerned about the fact that they're trading against people that are smarter than them. And so if you've got a bunch of those investors in the market in some sense is too liquid. And a market that's too liquid is going to be a market that's going to tend to underreact to information. Okay, because you've got a lot of liquidity. I learned something. I know what I'm doing, and I'm going in, I'm buying that stock. If I can buy as much of that stock as I want without moving the price too much, that means the price tends to underreact. So that's what was happening in the sort of more liquid developed markets. I think in the less liquid, less developed markets, you'd get a lot of noise trading, and these guys would move prices for no reason. And when that happens, you see reversals. Okay, so you get a little bit of what we're saying that's causing momentum in Japan in the 1980s, but that's offset by a lot of guys trading on noise and moving the price because the market's illiquid. So sort of the reversals that happen for that reason offsets the momentum that happens from the effect that's driving momentum in the US.
Momentum is a factor that many investors actually try to combine with other factors, particularly value. You wrote a paper in 2016 with one of our previous podcast guests, Greg Fisher, and also Ronnie Shaw was a co-author of that paper, where you showed that combining value and momentum actually outperformed value and momentum when run independently. Can you talk about what some of your findings were from that paper?
Okay, well, the basic idea is that the momentum and value kind of fits well together because the strategies are not that highly correlated. So these are two signals that are advantageous to, diversify across. And again, we're not the first to say that. I think AQR was making that point as well. And all we're trying to say in this paper is that it's more efficient if you're combining them into one portfolio rather than, take a value portfolio on one hand and then take a momentum portfolio and then basically own equal parts of those two portfolios. So again, the idea is there's different ways of basically selling this product. I could be in the business of doing ETFs, and I have my momentum ETF and my value ETF, and I tell my investors to hold a little bit of both. What our claim is if we had one ETF that combined the two things together, it would outperform.
One of the things you discussed in that paper is how value and momentum can be sometimes challenging to combine because value tends to be a slower investment signal where momentum tends to be a faster type of signal. So how did you actually tackle that problem in your research?
Yeah, I don't think we did a great job addressing that. And I think that's just a general challenge to anyone in the quant space. And I don't have a great solution. It's an engineering problem, really. And so anyone that's a quant investor, this is something that they just sort of have to address. You've got to think in terms of the speed of your signal and the liquidity of the assets that you're going into. So in the extreme case, if you've got a very, very fast signal, it's better be the case that you're going in and out of stocks that are relatively liquid. And if you've got a very slow signal, you can be a little bit more patient and get into and out of less liquid stocks. So I don't have a quick formula here, but if you're running a quant fund, this is something that you've got to take very carefully, the liquidity of each of the stocks, the speed of each of the signals, how to combine all that together to form a portfolio.
I want to shift gears and talk about another paper you wrote. We've seen a lot of wealth creation sort of in certain areas of the country, specifically Silicon Valley. But you wrote a paper talking about the relationship between firm value creation and location. And I'm wondering if you could maybe just talk about the major findings you had from that paper.
Okay, that's an interesting paper. And a couple of things I ask of people, the question is, if you're trying to describe value creation in firms, what is more important as an attribute, the industry they're in or where they're located? And the answer everyone will say is, of course, it's the industry. And that's correct. What's surprising is that location is also important, not as important, maybe 1/3 is important in terms of describing what's leading its returns. The other thing that people find surprising is I say there's two cities, metropolitan areas in the United States. And if you look at all the value created by new firms in the last 50 years, these two cities dominate. And the question is, what are those two cities? You guys probably should be able to guess those two cities.
I guess I would say San Francisco, the Bay Area, and New York City, maybe?
It's the Bay Area and Seattle. And then the question is, if you look at all the new firms created over the last 50 years, what percentage of the value is created by firms in those two locations? What would you say that is? This is all new public firms.
I mean, I'm totally guessing here, but when you think about the top firms in the S&P 500, Microsoft, Apple, Amazon, Facebook, Google, I don't know, maybe like 40 or 50% of the total sort of value. Am I close or no?
Okay. It's, when I last looked, it was about 80%, and it could be up to 90% now. It's most of the value is created in just those two cities over the last 50 years. And the interesting thing is it's not just the tech companies. Okay, Seattle's been amazing. Like Costco, if you look at, the retail space, Costco's done the best, and that's the Seattle company. If you're looking at sort of retail fast food, Starbucks has been the best. That's Seattle as well. So you've got lots of different types of firms as well. So yeah, location seems to be incredibly important in terms of value creation. One thing that we've looked at was sort of stock returns. We were basically looking at cities that we would call glamour cities versus value cities. Okay. And we would get a measure of sort of glamour value at the city level. And I guess the easiest way to do that is to look at the average market to book ratio of firms in each city. And the cities with the high market book ratios are the glamour cities. The ones with the low market to book ratios are the value cities. And you can, do sort of the same type of regression that we're used to doing, where we regress returns on the book to market ratios of the firms themselves and the book to market ratios of the cities. Okay. Basically the idea is the glamour cities are associated with high returns relative to the growth cities. And this was extremely important in the 1990s.
That's really interesting. You mentioned the idea of book value, and one of the things, book value in our world is very under fire these days because of the idea of intangible assets. And I'm just wondering, how did you deal with the difference between market value and book value? How did you deal with intangible assets when you looked at that?
Okay, we did it just a very simple market to book ratio, where we don't take that into account. There was a paper by a couple guys at Wharton that had adjusted market to book ratios. We used their measures as well. And they were adjusting for intangibles.
Yeah. And by the way, anyone taking that idea that Sheridan just talked about and putting that into an ETF, just make sure he gets a cut and we get a little small piece of the fees too. Just kidding.
Another thing you looked at the paper was this idea about, does location matter more for certain types of companies? So for instance, large versus small, or new versus old, or in certain industries. I'm wondering, was the location effect different in any of those types of scenarios?
I think for the new companies, location matters the most. So it's a new company thing. New companies know that. And so the cities that we list as our glamour cities, those are the cities that have most of the IPOs. So like 90% of the IPOs are in just a small number of those cities.
Before I hand it back to Justin, I just want to ask you one other paper you wrote. One of the ideas that's been a huge idea in the markets recently is this idea of disruption. And if you could sort of measure the disruptive climate, and you wrote a paper where you looked at, whether you could develop a factor based on the disruptive climate, and then sort of how that influenced factor returns. And I'm wondering if you could just summarize your findings from that paper.
Okay. I think you're referring to a theory paper where we're talking about that in theory, not in practice. So I've done a little bit of that, nothing published, and looking at ranking firms by, again, intangible capital, R&D, things like that. And when you do that, you show very strong excess returns in the 1990s. Okay, so the idea was there's disruption in the 1990s, and the firms that had a lot of intellectual capital did extremely well in that period. And again, firms located in San Francisco and Seattle did extremely well in that period, and not just the tech firms. Yeah. So I guess, in a disruptive climate, you want to be around smart people is sort of the bottom line on that.
Just before we wrap up, I had two more questions here. The first one was about sort of how professional investors utilize the research that's coming out of the academic world. So do you think there are any things that practitioners are getting wrong or they could do better when using academic research to build real world investment strategies?
Well, and again, you guys tell me what you think. Originally, the view of the academics was, once we publish our articles, it's kind of too late because it's in the public domain and everybody seems to know, the idea. So, it's not worth too much. When I talk to people, that are in this business, they seem to, be willing to take seriously, old academic articles. I'm not sure if I'd say they're getting it right or wrong, but from the academics, we originally, saw that and found that surprising. Now, it could be the case that the best thing that the people in the industry should be doing is reading the academic articles and then, coming up with a twist on the ideas and thinking about a way of implementing it better. And I know a lot of people that are basically in that business. The thing that I actually find surprising, I will say it's what they get wrong. But again, talking to people in this business, they've got models that to a large extent rely on the, the assumption that investors are overconfident and they have strategies that try to exploit that overconfidence. And again, I'd say the momentum strategy is a strategy that exploits investor overconfidence. Given that, I find it surprising that the quant investors are still incredibly overconfident about the efficacy of their own models. The mistake that was made twice in this business was that there are people that were in this business, I think, overestimated the liquidity of the markets. The LTCM breakdown, to a large extent was a liquidity event. And I think in 2007, it was a liquidity event that killed the quant guys. So that's happened twice at least. I'm not sure whether people in that business are taking liquidity more seriously now than they were before, but that was something they were clearly made a mistake with.
And lastly, our standard closing question, based on your experiences in the market and the research that you've done, if you could impart one piece of wisdom or teach one lesson to your average investor, what would that be and why?
Okay. For the average investor, I think in terms of advice, we both exaggerate sort of the efficacy of these models and also exaggerate the risk. So we've got two types of people. One is advice of, telling everyone to lean towards value and momentum and those sorts of things. Because the history tells us that. And the other is basically saying, you guys are uninformed investors, just buy the market and do nothing else. I think it's something both sides exaggerate. I think that I don't think it's too risky for retail investors to tilt a little bit towards these factors and to, be a little bit active if that's what they like doing. The cost to doing that, I don't think is particularly large now. The markets are pretty liquid and you can trade without commissions. So as long as you don't do things completely crazy, I don't think you're going to lose your shirt on that. As long as these guys understand that, the first thing they need to think about is having a portfolio that's pretty well diversified. But on the other hand, these markets are pretty efficient. People like me were mainly in the business of doing history rather than predicting the future. And so I would argue that I've looked at these markets and I think we've pretty thoroughly rejected sort of the formal view of market efficiency. If you look back in the 60s, 70s, 80s, 90s, I think the evidence is that the markets after 2000, at least in the United States, look reasonably efficient. So I would suggest that retail investors, go into this thinking that they can, in some sense, beat the market.
Sheridan, thank you so much for joining us today. We really appreciate it. We look forward to continuing to follow your research, and we will put links to these papers that we discussed in the show notes. So thanks so much.
Thank you. We really appreciate it.
Thanks. It was fun. Okay, bye-bye.
Hi guys, this is Justin again. Thanks so much for tuning into this episode of Excess Returns. You can follow Jack on Twitter at @PracticalQuant and follow me on Twitter at JJ Carbonneau. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.